My name is Cale Joyce, and I'm pleased to present a comprehensive market analysis for the Lake Forest Mall site located in Gaithersburg, Maryland. The intent of the analysis is to support the idea of a multi-phase, multi-use development opportunity on the target site. XYZ LLC is a full-service commercial real estate company managing over 42 million square feet of retail, office, industrial, and multifamily properties for equity partnerships and third-party owners. XYZ specializes in real estate brokerage services, tenant representation, investment services, asset and property management, economic incentive consultation, financial services, construction and development services, and XYZ funds. Since the economic recession and real estate burst in 2009, interest rates have been low and growing at a steady pace. In the early years following 2009, asset prices, including real estate, have raised above their intrinsic value. Properties in Tier 1 or primary markets have continued to trade at compressed cap rates due to their liquidity premium based off location. XYZ projects that the economy will continue to maintain strong over the next year. Low employment rates provide more money being added back into the economy, which consequently results in the Fed having more leverage to raise interest rates. Specific to Gaithersburg, the Suburban Maryland multifamily Q1 2018 report from CBRE stated that Montgomery County had the lowest unemployment rate of suburban Maryland at 2.8%. It is becoming progressively difficult to acquire buildings with the rise of interest rates. We believe the increase in interest rates don't correlate with a reduced number of transaction volume in Tier 2 secondary and Tier 3 tertiary markets. Investors from Tier 1 markets will need to place 1031 exchange money from properties they acquired the pre-bubble burst from 2008 to 2009. We believe that these investment groups are proactively looking into Tier 2 and Tier 3 markets as there is an opportunity to develop larger properties and capitalize on companies who have been expanding to larger spaces in these markets, such as Gaithersburg. Utilizing the information in this slide deck, we are confident that the site provides an opportunity to develop a mixed-use site that upon stabilization will be attractive to Tier 1 investors. The target site is conveniently located off Main Highway 270 in Gaithersburg, Maryland. The site is 23.1 miles north of Washington, D.C. The grounds of the site total approximately 2,935,535 square feet of land, which is around 67.41 acres. Development site. In the map, light blue represents retail, yellow represents residential, red is the target site, green represents office, and the dark blue is flex industrial space. The orange boundary that surrounds the image above highlights what we consider as the target area for analysis of residential, retail, office, and flex industrial space. Reducing the scope of analysis to this area has allowed us to focus our attention and further our understanding of the surrounding market. Over the next couple slides, I will be talking about the site conditions. To start, there's not any kind of outdoor community space that offers respite. We consider this an opportunity to work with landscape architects and city officials to create a mutually beneficial space for the site and surrounding neighborhoods. Gaithersburg High School is located 2.1 miles away from the target site. The school reported a total of 2,388 students from grades 9th through 12th grade. January of 2017 was the most recent Gaithersburg Police Department crime analysis report. This stated that their fourth quarter 2016 crime analysis showed a 14% reduction in crime from the previous year. Lastly, the target site does not sit on a floodplain and is not at risk of becoming one. There are currently 7 points of entry from the surrounding roads to the target site. It will be later recommended that the roads inside the land be redesigned. The 7 entry points are important as the city has previously approved these entry points and determined that they will not impact traffic flow around the target site. Looking at the map, you will see 7 stars which represent the entry points. There are 4 parks within 3.1 miles of the site. A respite area on the site has the potential to add value to the area. The 4 parks within the area are Seneca Creek State Park, Centerway Park, Strawberry Knoll Local Park, and Brown Station Park. These 4 parks are represented in the map in front. Around the target site, there are 4 main roads. Aldenhall Avenue, which runs generally northeast to southwest, has no obstructed views from the roadway. Lost Knives Road, which runs generally northwest to southeast, has no obstructed views from the roadway. Russell Avenue, which runs generally northwest to southeast, has predominantly no obstruction of views from the roadway except for an approximate 1,048 feet of obstruction due to trees that surround a water runoff pond. This is shown on the map. Montgomery Village Avenue does have obstructed views from a combination of berms that are at a higher elevation than the road and trees that run alongside the roadway. The most common industries in Gaithersburg are professional, scientific, and technical services. The most common positions in the market are management and computer or mathematical positions. The 2010 census report shows that Gaithersburg, having a population of 83,788, with a projected population estimate of 94,500 in 2020. Utilizing data from the census, there is a projected increase in population of 12.8%. This information is critical to take into consideration as we project future demand for office space. CBRE has reported that Q2 of 2018 has an inventory total of 4,992,491 square feet. Class A office space makes up the largest portion of the total inventory and has the lowest vacancy rate in the market. The Q2 2018 data shows negative absorption rate for Class B and C properties and considerable absorption for Class A. This proves that tenants are vacating their previous properties and moving into newer Class A properties. With a vacancy rate of 6.1%, we can conclude that there are high demand and not enough supply in the market to reach a vacancy threshold that would prevent new development. It is reported that Q2 2018 has no office space currently being developed, which heightens opportunity. The last big push in office development was reported by CoStar at 1,162,814 square feet of office space. Out of the total square feet of office space that was being developed, 50% of the office was pre-leased. Pre-leasing of property is typically due to build-to-suite development. Gross asking rent per square foot are strong at an average of $23.57 for Class A properties. With an estimate of $9 per square feet of operating expenses, we estimate an average triple net lease at $14.57 per square foot. With Gaithersburg being in a Tier 3 market, we believe properties will sell between a cap rate range of 6.25% and 7%, depending on how creditworthy tenants are. Gaithersburg saw a wave of sales transactions for multifamily properties that allowed value-add investors the financial feasibility to renovate properties and raise rental rates in the market. The market responded positively to the rise of rental rates and actually strengthened occupancy levels. CBRE reported in their Q1 2018 suburban multifamily report that Gaithersburg had an overall occupancy of multifamily at 94.3%. This high-level occupancy shows that at the time of the quarterly reports, 1,573 units out of the total of 27,581 were vacant, which is spread over the Class A, B, and C multifamily properties. As seen in the above chart, rental rates for nearby multifamily properties spread between $1.25 and $1.89 per square foot. Utilizing the notes to the right side, we would consider each of these properties as value-add deals. There is a lack of amenities in the multifamily properties in the market. We believe rental rates for Class A multifamily properties with a multitude of amenities could easily bring consistent rental rates in the $1.65 to $1.95 per square foot range. We estimate the cap rates for stabilized Class A would be able to trade in the high 5% to low 6% range due to the properties being in a Tier 3 market. We believe Class B and C properties likely trade at a resale cap spread of 6.5% to 7.5%. For our analysis on the retail site, we look near the target area to increase our understanding of what surrounds and therefore be able to make a confident recommendation later on. In addition, our analysis reduced the scope of retail to 6 categories: restaurants, bars, men's, women's, kids shopping, and footwear. Utilizing site-wise as our basic data, we have analyzed the 2015 and 2020 aggregate expenditure estimate along with percent of growth forecasted. There is a large amount of money spent each year on our strategically selected scope of retail. We analyze these based on what we believe will have the largest impact on the site and what will be in direct competition with what we recommend later on. Utilizing a conservative 15% capture rate based off the total amount of multifamily units that were analyzed previously, or 928 units, we determined that the area would be able to support 98,893 square feet of retail space. Currently, there are no retail developments within a 5-mile radius of the target site. Within 1 mile range of the target site, there is one Dunkin' Donuts, 2 McDonald's, and one 7-Eleven. In addition, there are over 20 restaurants. These retail sites are in place will minimize the need for retail as new development is initially erected. Multiple grocery stores currently stand within 1 mile to include Sam's Club and Trader Joe's. Montgomery Village Avenue is the major roadway near the site with an average amount of people traveled at 92,702. This includes both directions of travel. This is a positive impact as retail will be highly visible. The current complications is that there is only one entrance point on that side of the road. A mixed-use development site would have multiple positive benefits that include revitalizing the area, increasing tax revenues to local neighborhoods, creating more jobs and shopping to residents, while containing the growth that the city currently has into a more dense neighborhood district, which is attractive to both people in the area and potential investors for the property. There is no doubt that the site offers a vast amount of ground in a suburban environment that is not possible to find anywhere else in the area. A mixed-use development would mitigate the challenges of resale by allowing multiple exit strategies that would be difficult if it were one singular development. The development of a mixed-use site of this caliber would be historic to Gaithersburg and easily gain recognition in the DC area. It would have the ability to create more office jobs and allow companies to grow, which would have significant impact. More multifamily will allow for more options of luxury living in the area and a place for those who want to sell their home and live worry-free of any maintenance issues. Retailers will be able to thrive in an area where there is a dense amount of people and easy access for those in the surrounding area to come to. Upon approval and discussion with the city, a mixed-use site has the potential to incur TIF incentives to revitalize the area from what theoretically is currently a blank slate of raw land. The local area, to include public schools, would generate multiple new sources of tax revenue that would have a direct impact back to the community. Our recommendation for development is to split the land into a 10-parcel, multi-phase, mixed-use development site. 4 parcels would be planned for office, 3 planned for multifamily, 1 planned for 4 retail pads, 1 slated for senior housing, and 1 combined multifamily retail use. Upon completion, the site would feature up to 600,250 square feet of office, 1,382 multifamily units, approximately 40,000 square feet of retail space, and 116 units of senior housing. We recommend a multifamily mix to be predominantly designed around studio, 1 and 2 bedroom units. We recommend podium multifamily buildings with additional parking on the outside. The ground has enough room for a singular roundabout that would divert traffic of office and multifamily tenants. We recommend having retail close to the outside road with highest visibility, but near the multifamily properties so people have quick access to the sites. Due to the number of units, even with multiple complexes, the economies of scale would be high enough to reduce overall construction cost per unit. It would be estimated that the total cost of the development for the entire site would be between $325 million to $350 million, utilizing a 7 to 7.5% yield on cost. This strategic structure of mixed assets would allow for multiple exit strategies that would mitigate the challenge of having to liquidate the asset as a singular deal, which ultimately would have a limited buyer pool. Our company has had historical success with structuring new development sites with this mix of assets. The success of our development should be considered in your planning and execution of the development, as we can streamline your architectural, construction, and management services by utilizing comparable design and operation structures. During phase 1 of the development, we recommend breaking ground on the senior housing property and first multifamily property. In phase 1, we would aggressively market the opportunity for a Class A office build-to-suite with the intent to execute a contractual agreement with a tenant. Phase 2 would begin once the senior housing and first multifamily property have stabilized. We would not consider the start of phase 2 until at least in a negotiation with the build-to-suite office tenant. Upon executing a build-to-suite contract, the first office building would begin, followed by the second multifamily. Phase 3 would be considered once phase 2 is stabilized. We recommend phase 3 including the development of the retail space in conjunction with another build-to-suite tenant. Phase 4 would be to add the final combined multifamily property. Dependent on the brokerage services executed, we would be open to developing the additional office spaces during any of the phases of proposed build-to-suite ground. If during phase 4 we do not have any executed or contracts in place for build-to-suites, we would not recommend doing any execution in developing these office spaces, but continue to market them and wait for a build-to-suite to occur. Below you will find information on myself and the experience that I've had at XYZ LLC. Please feel free to contact me at the email below with any questions or concerns or clarification that you would like to have on the market analysis. I appreciate your time and hope you've enjoyed this market analysis. Please take the time to refer to any of the marketing materials that I previously submitted and let me know if there's any questions that I can assist with. Thank you.